This will be Mailbag Webinar Episode 3, and I'm just going to answer questions that I received from you guys, and we will run down. I've got 4 questions, some good ones here, and yeah, so let's get to it. So the first question I received is, what is my view on managing money for people? Say if someone wants to give you a substantial amount, but you've only been trading small amounts for yourself, do you think it is possible to use the same strategies you might use on a smaller account on a bigger account as well? So my stance on this is it depends on who the person is that wants you to manage their money. I have a rule personally that I will never ever manage money for friends or family, and the reason for that is that there is very little upside compared to very high downside. The downside is obvious. You could lose their money and it could affect your friendship or your relationship, family tension, whatever it may be. So that's not the reason I don't do it though. The reason is because of the lack of upside. Think about it. What can be gained from making your friend or family member money? They already love you as a person, so are they going to love you or respect you more because you made them some money? And are they going to treat you differently? Are they going to treat you better? Right? I mean, these are friendships that are embedded over years and years, so no matter how much money you make someone, it's probably not going to change their view on you, other than they'll be like, oh, okay, so he is good at what he does. But if they're basing their friendship on the amount of money you're able to make them, then you should probably question the motives of that friend or family member. So bottom line, I just don't think there's very much upside in managing somebody's money who you're close with, be it a close friend or a family member. Now, if it's on a professional investment level, then to me that's much different, because first of all, that type of investor likely has a much better understanding of the risks involved when turning their money over to someone else. And secondly, there is no friendship at risk, as it is strictly a professional relationship in that case. But again, the bottom line, and I have experience with making trades or investments for friends and family, and I can tell you that it's really not worth it. I have made money for friends and family. I have lost money for friends and family, and what I noticed in my experience is there was always very little to be gained and very much to be lost. As far as applying the strategies you would use on a small amount of money to a larger amount of money, I don't see why there should be much difference. At the foundation of any good strategy is a disciplined risk management or capital allocation model. For example, if I have a $10,000 account, which we'll just call that a small account, and on average I risk 3% per trade. One sec, just gotta help somebody. Somebody having trouble with the live stream. Sorry about this. Just give me 1 second so I can get this person situated. Alright, looks like they are here. If you are having any problems, just message me in chat. Sorry for the confusion. But so back to the strategies as far as a big account to a small account and what you might do with that. Again, I don't think there should be any difference in strategy with either of them. If I have a $10,000 account and on average I risk 3% per trade, then I'm risking $300 per trade. If I feel extremely confident in the trade, then maybe I'll put 7 to 10%, and now I'm risking $700 to $1,000. If I'm less confident, maybe I'm only going to put in 1% and I'm risking $100. Now, if I have a bigger account, let's call it a $100,000 account, it's still going to be the same thing. On average, I risk 3% per trade, which is the same amount of risk, but since it's a larger account, my dollar risk will be $3,000 per trade. If I feel extremely confident, I'll put in 7 to 10%, so I'm going to risk $7,000 to $10,000 per trade. If I'm less confident, maybe I will only put in 1% and risk $1,000 per trade. Bottom line though is both accounts are going to perform well if the strategy being employed is a winning one. I've never heard of a strategy that only works on a $300 investment but doesn't work on a $3,000 investment, unless there are liquidity constraints, such as, you can't buy $3,000 worth of the option. Maybe you're trading a very illiquid stock. But bottom line is, any winning strategy should be able to translate. Otherwise, is it really a winning strategy? All right. The key when going from a smaller account to a bigger account is that your capital allocation model stays consistent. Your risk management stays consistent. That's why I always base my losses on percentages, such as 3% of my account or 1% of my account, as opposed to the dollar amount. Because obviously, if we go back to this $10,000 account and we risk $3,000 on the trade, now we're risking 30% of the $10,000 account. That is a much bigger risk. So the key is your capital allocation, in my eyes, more so than the strategy itself. I'm going to skip number 2 because it's kind of the longest question, and I'm going to go to number 3. So sorry about that. Just bear with me. We'll go back up. But so next question is there an equation you can use to help determine how much money you are willing to risk per trade? This is a great question, and I actually just came across an equation that this guy Dave Kelly of catalysts-headwinds.com recently published. It was a very good article if you check out his site. And here is what the equation that he came up with looked like, and I'm going to share it with you guys because I think it's phenomenal. And that is your max dollar risk divided by your max risk per share equals your amount of shares to purchase. And so the way you would put this to use is, first you would determine how much of your portfolio value you are willing to lose. So let's say you have a $12,500 account, and you're willing to lose 1% of that portfolio on a trade. That is a $125 loss. So $125 becomes our maximum dollar risk. So if we look at Apple, for example, Apple is currently around $115.50, and it has gap support from a couple weeks ago at $113.50. So I say, all right, I'm going to go long Apple at $115.50, and my stop loss is going to be $113.50. So our share price risk is $2 per share. We're willing to risk $2 per share. $15.50 minus $13.50 equals $2. So in order to figure out how many shares to buy, we would divide $125, which is our max dollar risk, by $2, which is our max share price risk. And that equals 63 shares. So we would purchase 63 shares. This would take up $7,276 of capital, or 58% of our total capital, based on a $12,500 account. Now, my target is a bounce back to 120, which is the 1 month high. And if it gets to 120, I'm going to make $238 in profit. If I end up getting stopped out, I'm going to lose $125. We've already established that as my maximum loss. And that equates to a 2.26 to 1 risk to reward ratio. I think that is a very good risk to reward ratio. Again, the equation here is your max dollar risk. I'm willing to risk $125 divided by my max risk per share. I'm willing to risk $2 in Apple's share price, and that gives me the amount of shares I'm able to purchase based on that. And now this equation is best used when trading stocks because you don't have as much volatility risk as you do with options, and there's obviously no time decay risk either. In addition, because of the way it is easier to control losses with highly liquid stocks like an Apple, you can allocate a greater percentage of your portfolio than when trading options. I would never put in 58% of my trading capital on an option trade, because options can move 20-30% in a blink of an eye. So it'll be near impossible to be able to maintain that max loss of $125 with options. But with shares, it's not as much of a concern. Yes, we still have overnight volatility risk. Apple could always gap down to 110 from our 115 entry, and our max loss would kind of go out the window. But assuming there's no earnings coming out, how often have you seen Apple gapping $5 on an overnight basis? Maybe the flash crash back in August is kind of the only time I can think of that I've seen in over a year, again with the exception of earnings. So yes, the overnight volatility is a risk, but again, it rarely happens, and you just got to be smart about timing. You maybe wouldn't want to do this in a highly volatile market because of that overnight risk. But the other benefit of trading shares versus options would be that you could exit the position as early as 5 a.m. in the morning. Pre-market opens at 5 a.m. I believe it might even open at 4:30 a.m. I'm not sure exactly because I'm always asleep at that time. But again, you can sell shares pre-market as long as you have a good enough broker. So if you did wake up and you saw, okay, Apple is at 1550 the previous day, but now it's gapping down to like 114, and it looks like it might be below 112 by the open per se, you could choose to exit it pre-market. So that's a benefit of using this on shares. And what I like most about this equation is it provides a clear model for trading shares with a smaller account. I think most often when I talk to some of you guys, you tell me, oh, I can't trade shares because I only have $7,000 in my account, or I only have $10,000 in my account. Well, this still gives you a clear model to use to still make that trade, and you can make a meaningful trade with shares on higher price stocks, even with a $5,000 to $15,000 account, as long as you stay disciplined in calculating your maximum risk and go from there. Now, can you apply this same equation to options? Yes, but it wouldn't be as efficient due to the volatility risk. All you would do, though, is instead of calculating your max risk per share, you would calculate your max risk per contract, and that would give you the amount of contracts to purchase. But again, it wouldn't be as great. When it comes to options trading, as far as the equation that I use, that's where I come back to this example up here in terms of my personal allocation. I generally trade maybe, and usually it's not even this, but I'll trade maybe 3% per trade on my options. Usually it's a lot closer to 1%. When I trade options, honestly, this doesn't ever happen usually, but I always assume I can lose 100%, because options, it's just a different animal. So if I'm buying a single option, I always assume I can lose 100%. So my equation with options is typically 1% of my portfolio at risk at a time, maybe 3%, and in extremely rare cases I'll maybe get up into that 5 to 10% range. But the equation for options would be whatever you are prepared to lose 100% on, that is what you can risk. So next question is, what do I think of strangles and straddles as viable option strategies to catch directional movement, and what would you consider before putting on such a trade? So first of all, just to make sure everybody understands what a strangle and a straddle is. A strangle is an option strategy where you hold a position in both a call and a put with different strike prices, but with the same expiration date and underlying asset. This option strategy is profitable only if there are large movements in the price of the underlying asset. So for example, Tesla this week, the 222.50 put and 227.50 call strangle can be bought for $3.94. Break even on this strangle, meaning where you need the stock to be at expiration in order to profit, is either below 218.56, and the way you calculate that is you take the 22.50 strike put minus the $3.94 that the strangle costs, gives you $218.56. So you either need it to be below 218.56 to break even or above 231.44 to break even. And again, the way you'd calculate that is you take the call strike, the 27.50, and you add the cost of the strangle, which is $3.94. So if you think Tesla is going to either go down to 215 or up to 235 this week, then this trade is appealing because such a move would exceed the cost of the strangle. However, if you think that Tesla is just going to stay between the range, 218 to 231, then this trade doesn't make sense. So that's a strangle. A straddle is an option strategy where you would hold a position in both a call and a put with the same strike and same expiration date. So using Tesla again as an example, and these are real prices based on today's closes, the Tesla 25 put by 25 call straddle can be bought for $6.20. Break even on the straddle, it's pretty close to the strangle, is 218.80. And again, the way you calculate that, you take the 25 put and subtract $6.20, which gives you 218.80. So you need to be below that to break even, or above 231.20. Add the cost of the straddle to the strike of the straddle, which is 225, gives you 231.20. So if you think Tesla is going to be above 215 or below 215 or above 235, then again, this is an appealing trade. But if you think the stock is going to stay between the range, then this trade doesn't make much sense. So rule number one, and really the only rule when it comes to strangles and straddles as far as I'm concerned, is that they are only viable strategies if you think the stock is going to exceed the range that is being priced in by a particular strangle or straddle. So the first step in determining this belief, outside of your own general thoughts on the stock, is to calculate the priced in move. Here's how to calculate the priced in move for those of you that don't know. And this is extremely important. I remember the first time I learned how to do this, it just opened my eyes and really helped me understand options pricing much better. So to calculate the priced in move, you take the at the money strike call and you add it to the at the money strike put, and that gives you the priced in move. So Tesla's right around 225, so the 225 strike call is at the money and the 225 strike put is at the money, and the total combined cost of those is $6.20. So you take that information and you can say that the market is pricing in a $6.20 range for Tesla for the rest of the week. That is a 2.7% percentage change. So the market is saying Tesla is going to move 2.75% this week. Doesn't know if it's going to be up, doesn't know if it's going to be down, but that's what the market is saying. And again, there's only 2 days remaining. So what I would do next, as far as now I determine is a straddle or a strangle a viable strategy, after I've calculated what type of move the market is pricing in, I would then go compare that priced in move to Tesla's average percentage movement over the given time period. So in this case, there's only 2 days left in the week, and the market's pricing in a 2.75% move. So what I would do is calculate Tesla's average percentage movement over the last few Thursday, Friday combinations. And I would say that you probably want to get a data size of at least 10. Anything less than 10 is too small. All right. And so I did 7 just for the purpose of, this example, but you would want to do more if you're really going to do this. So again, what you do, if I'm making this live trade, I'm going to go back and I'm going to look, okay, what type of percentage change has the stock seen over the last few Thursday, Friday combinations? I have 7 returns here. You can see last week Tesla moved 0.7% on Thursday and Friday from Wednesday's closing price. The week before the market was closed, earlier it moved 0.4%. There's really only one big move here, and that is November 12th and 13th when Tesla moved 5.4%. The average Thursday, Friday movement over the last 7 weeks for Tesla has been 1.5%. And again, I would get a much bigger sample size if I was really going to do this, but just, showing you guys a educational example, this will do for now. The average move has been 1.5%, but the market is pricing in a 2.75% move. So if I was really making this trade, I would probably avoid it, because based on this small sample size, the market has overpriced Tesla's expected range for the remaining week. Again, it's a small sample size. I can't emphasize that enough. But if I'm really doing it, I see that the market is pricing in a 2.75% move for the week, and Tesla on average has only moved 1.5% on Thursday and Friday over the last few weeks. So I would say the market has overpriced the move, and therefore it isn't an attractive cost of the straddle or the strangle, because I don't think based on that Tesla can exceed the priced in move. And the key with buying a strangle or a straddle is that the stock needs to exceed the range that is being priced in by the market. Now, depending on the time frame of your trade idea, you would want to examine different time frames of volatility. So for example, if you were entering a straddle or a strangle with a 30-day time horizon, then you need to examine historical monthly volatility. If you were entering with a weekly time horizon, you would need to examine historical weekly volatility. If entering for a day trade, then historical daily volatility is most important. In my example, I'm considering a strangle or a straddle just for Thursday, Friday, so I examined the last few Thursday, Fridays. But maybe I'm looking at a strangle for January. I would want to go back and look at how has Tesla performed during the January month. Now, the bottom line question of do I think strangles or straddles are a viable strategy? I honestly have never bought a straddle or a strangle, so I can't offer a viable opinion on the strategy. But if I was going to enter such a trade, this is the criteria that would be most important to me. Number one, I would want to buy a strangle or straddle that appears underpriced compared to historical volatility. So for example, say that the stock has a history of moving 10% during the month of January over the last 15 years, but the options market is currently only pricing in an 8% move for the month of January. Then that would look attractive, because I could say, okay, the options market has underpriced the historical volatility, so the premium on the strangle or the straddle is affordable, or at least cheaper than historical prices have shown, or historical returns have shown. That would be number one. Number two, if I can find a strangle that is significantly cheaper than a straddle but contains the same break-even price range, then that would be a better entry than the straddle. So for example, earlier we looked at the 2250 put by 2750 call strangle on Tesla, which cost $3.94, and the 25 put by 25 call straddle, which cost $6.20. Both of these contain similar break-even ranges of roughly $218.50 to $231.50, but the strangle costs $2.26 less than the straddle. So I need to compare my break-even ranges and the costs to own when determining if I'd rather buy the strangle or the straddle. Now, there is a hypothetical scenario to consider here. If you owned a strangle or a straddle and the stock broke hard in one direction, you could always choose to lock in profits on the winning strike and see if the losing side recovers on a counter trend move back up. For example, the last 3 days, Netflix fell from 131 to 121, and then it bounced back to 128 before closing today around 124. Coming into the week, the Netflix 125 straddle opened on Monday at $8.25. Now that was its high for the week. So if you bought the Netflix 125 straddle, you can see it priced here. This is Monday at the bottom right here. The left-hand side of this chart. This is Monday, and you can see this is the 25 put on the bottom and the 25 strike call on the top. Obviously, they moved in opposite directions. So they opened at $8.25. That was the high for the week. So if you just held on to this straddle all week on Netflix, you are losing money to this point. The straddle has gone from $8.25 and now it's only worth about not even $4. So that's been a losing trade. But the 125 put went up to $4.90 from 65 cents. You can see here on Monday it was at 65 cents, and on Tuesday's gap down it hit nearly $5. So you could have sold it at that $5 area. You could have exited the put side of the straddle, held on to the call, which was around $2 at the time. Well, earlier this morning, the next day, that call recovered back up to nearly $5. So then you could have exited that, anywhere between $4 and $6. So if you would have traded in and out of both sides perfectly, you could have netted a total sale of $10 to $11 on the straddle compared to the $8.25 entry. But that assumes you did everything perfectly. That assumes you nailed the top when exiting the put, and that you didn't get shaken out of the call, and then you nailed the top when exiting the call. And in theory, I think it's very easy to imagine that we can sell one side at the right time and then hold the other side for the recovery. But in reality, it is likely much, much harder. So this is a hypothetical scenario. It is totally realistic. You can do it, but you have to be very, very skilled. And I think it's very, very hard. So I wanted to mention this hypothetical scenario because some people have brought it up to me. But I would stress that if you're going to buy a straddle or a strangle, in my opinion, if I was going to do it, I would do it with the idea that I was going to hold on to both sides and exit both sides at the same time. Not one or the other, because if I'm exiting one or the other, now I have to do things perfect, and then it's too hard. Now I see a question posted during this conversation, what about pre-earnings? And again, it's the same concept that I was talking about up here. Straddles and strangles, that's when people talk about them most, is around earnings season. And again, what you would do, you would calculate what is the priced in move. You would look at the earnings week premium and see what is the market pricing in. A stock like Netflix next month reports January 15th or something like that. The market's probably going to be pricing in anywhere from a 7 to 12% move, I would imagine. And what you would need to do, or what I would say you need to do, is you look back at the previous earnings reports over the last few years and you say, how has Netflix stock moved on average during earnings? Netflix, has it typically moved 5% the day of earnings, or has it typically moved 15% the day of earnings over the last 5 years? And most importantly would be, how has it moved on the January earnings report? I always relate the quarter to the quarter. For instance, what you'll notice is, and don't hold me to this, but Apple, I believe, just off the top of my head, typically makes a much bigger move on the January quarter than it does in the March quarter. So, and again, that's just off the top of my head. I'm not sure about that. But if that is true, what I would do then is I would put more emphasis on the historical January earnings report volatility than I would the 4 quarters volatility combined. Because Apple might only move 2% on average 3 out of 4 quarters, but then there's that one January quarter where she moves 4% on average. And so I would look at what is the market pricing in. If the market's pricing in a January move of only 2%, and I know that the last 4 Januaries Apple has always moved 4%, then I'd feel pretty good about buying that straddle or strangle, because I would feel that the market has underpriced Apple's volatility. But again, the key, whether it's earnings or Fed FOMC day, which is coming up next week, or just a random Friday on a December afternoon, you need to look at the data. You need to look at what is the average percentage change been. Use that history as a guide to kind of tell you, hey, are we underpriced, overpriced, or in line, and go from there. Any questions on this straddle strangle topic, or any questions on anything to this point? Because the next thing we're going to do is look at some film of some level 2 action, and that would be the last thing that I have to go over. Alright, not seeing any questions, so let's turn the attention to some film study now. And so what sparked this question, this film review, this is from December 2nd, so just last Tuesday or last Wednesday, I guess, one of those days. And the question was, at the time we were watching Netflix, I was trading Netflix, and Netflix was breaking out above 125, and I had made a comment where I said that the breakout looks legit, meaning the breakout above 125 looks legit. And this person wanted to know what made me think that it was a legitimate breakout. What did I see in the stock? So I'm just going to play some film and talk through it here and mention to you guys what I saw that made me think this was a legitimate breakout. So first of all, to set this up, again, it's December 2nd. Netflix has broken above 125, and the first thing I see is just huge volume. Number two, coming into the day, I had the all-time closing high of Netflix prior to this day was 126.45. So I had 126.45 as kind of a psychological level to keep an eye on. And when I was watching the stock, it just blasted right through 126.45. There was no slowdown at all, and you can see it came up into the 127. So at this point, I'm watching Netflix, and I have a bid in on the 123 strike call. So I'm trying to get in at $4. I'm not going to get filled at $4, and I end up buying in higher than that. I might even go to a different strike call. I'll have to see what it ends up looking like on the film. But bottom line, let's turn this on. Let's watch. I say bottom line a lot. But anyways, let's turn this on and watch, and I'll talk about what I was seeing on level 2 and time in sales that had me attracted to this. So the first thing is, after there's a big move made and we come above resistance, I'm watching to see how is it reacting. Is it coming back down really hard, or is it able to hold its price pretty well? So in this case, we just popped above 127 and we've come down a little bit. And I want to see if you whack out 127s or not. And what you're going to see is that it really doesn't whack out 127s. The stock's made a big move. It's up 1%. Look at our time of day too. That's important. It's 9:39. We are very early on in the day. The stock has gone above its all-time closing high within the first 10 minutes of the day, so I'm excited off of that. You can see here we've got an ask stack at 27.25. It tries to come down towards 27, whacks out 27s, but you're going to see the bids pop right back up. You see that stack come back at 27, whacks it out, but again, we get another stack back up. So there they are again, holding 27s. And when I'm seeing this type of action, I'm thinking from a psychological perspective. Number one, the stock's broken out. I've established that. So with that observation, I take into account, what are people who are on the sidelines looking for now? Well, I'm somebody on the sidelines and I'm trying to buy the dip. So now, if Netflix isn't dipping, what am I going to have to do? Well, I'm going to have to get in at a higher price than I was originally anticipating. So that's kind of what I'm thinking about psychologically here with Netflix. And again, in terms of the breakout being legit, it's just not coming down. It's just not coming down. It can't even dip 30 cents off that. I just want to rewind it again there to show how easily, once we got some space back above 27, how these bidders started jumping back up. So like right here, I paused it just for a moment. We've got ask stacking in these 2720s, and I'm watching to see if we're going to whack out the bids or not. And what you're going to see is the asks get taken out up to like 2740 in one order, or one rash of orders, which tells me there's a lot of buying going on, and there's just a lot of momentum potential, because again, we're at all-time highs essentially. So I'm already looking for that momentum. That's my expectation, and the volume is very, very high. You're just seeing good things in terms of continuation potential. And when I see it starting to flash back up towards 2750, that's my signal that, all right, she might not end up breaking down much below 27. So this is the action that's important. When we're testing 27, anytime we're at a dollar mark, 27, 26, 28, 25, anytime we're at one of those dollar marks, just pay attention to who is winning the battle here. We already know the bulls are winning the war because the stock's up 1%. So who's winning the near-term battle? The asks are having a really hard time coming below 27 and holding. They come below 27 right there, and right away they get taken out. Just going to rewind for a second just to show that. All right, I couldn't even catch it. It was so quick. I'm going to pause it when the asks are below 27, and then I'm going to click play again just to show how quickly they got taken out. Trying to get below 27. All right, look at this. So we finally get two asks below 27 at 26.99. And the question of how do I know that this breakout's legit? Here's one of my best signs. When we try to get asks going back down and they just get taken out right away. I'm going to click play again, and these asks are going to disappear in the blink of an eye. See that? They couldn't even stay down there. One tries to come back down again, they get taken out again. Tries to come back down again, it gets taken out again. And now what do the bids do when it regains 27? Does it regain 27 and go up, or does it regain 27 and come back below 27 on the ask side? Again, we have an ask below 27, tries to go lower, again, it takes it out. Now we're above 27, and now right away we're testing 27.20. Try to pressure 27 again. Bids are still defending that level. And look at that right there. Right in one quick order flow, we come up near 27.40. I'm going to rewind that just for a second, because that's kind of your second signal that this breakout is legit. Pay attention to how quickly we go from 17.10 to 17.40. Pay attention to this. It happens right around here. You see that? Didn't take more than 3 seconds. Paused it for a moment to talk about this. So when I see that ability to just spike up 40 cents in the blink of an eye, when we're at all-time highs, when we've already made a good move, it gets me really optimistic about what the stock can then keep doing. Because if we can move from 127 to 127.40 in 2 seconds like you just saw, then what's going to happen if it makes a new high? The high of day is 127.70. All right, well, if it spikes 40 cents off that new high, then it's going to be in the 128s right away. So when I see that type of movement happening so fast, it's a sign of a legitimate momentum push. And ultimately, that's why I start at this point raising my bid and figuring a way to get some long side exposure, because I do not think I'm going to be able to get a fill back near 126 where I was originally trying to buy in. Does this make sense so far though, in terms of the speed off of that 27 level? You can see it here as it's testing 27.50. So I'm getting an order ready. I end up buying the 125 strike call, which is 345 by 360. As soon as we flash above 27.50, I'm going to take a chase entry here. A chase entry is an entry that I refer to as kind of being more aggressive when you're not really at a support level, you're just kind of chasing the momentum. And that's what I'm doing here. I'm chasing Netflix's momentum when I enter that 125 straight call. You can see I've gotten my limit price ready at 350 to try and buy in there. And in my head, I'm thinking, all right, if you start flashing above 2750, you should just get in here. So here we go. You are starting to get above it. Nice stacking at 2750, trying to come back below it, but the asks get taken out just like we were seeing at 27. You're going to see these asks get taken back above 2750 off this little small dip, and it's just going to be another sign that it's really having a hard time dipping and acting like it wants to go higher. The whole concept with breakouts is, what do the reactions look like after the breakout? What is it acting like it wants to do? Netflix is acting like it wants to go higher in this case. At least that's how I see it. You can see again, right back to 2750. Still haven't entered yet, but I've still got my order ready at 365 now to get in there. Notice that my cursor is right over that buy to open button. I'm ready to go. The only thing holding me back here is I'm just trying to get a sense of if she's going to come back below 27 or not. But obviously right here, just underneath the high, starting to extend a bit more. I should get in right here if I remember correctly, because looking at this again, there it goes. Okay, so yeah, so I do get in. I chase an entry. You can see here it's highlighted. I end up buying the 125 strike call at $3.70. And now you come back below 27.50 again, but right away you get bought back up. So I just want to fast forward a little bit. So I've outlined the criteria that got me in this trade, and as we go forward, now we're making new highs. I fast forwarded by 4 minutes here. Now we're testing 128, and so again we're at that dollar mark, and it's the concept of who's winning the battle at those dollar marks. We're testing 128, we're on the highs. The stock still hasn't slowed down. It tries to come below 128, but the bids just keep forcing it up and just still looking like it's going to go higher. Why 27.50? 27.50, well, it's just right underneath the high of day. The high of day was 27.70, so you start getting above 27.50, now you're closer to 28 as opposed to 27, so that's where 27.50 was kind of that pivot point for me in that instance. And just to talk on that further, remember that 40-cent bounce, we saw that happen in the blink of an eye from 27 up to 27.40. So I know that the high is 27.70. Once I'm getting above 27.50, I start to remember that 40-cent rip that it made, and I say to myself, all right, well, if it does make a new high, it's shown the ability to really move. So that also plays a part in it. And you can see now we're staying on the highs, just continuing to have a very hard time going down. My options up to $4.25. I have a sell order placed at $4.65. And I'm just sticking with the stock. You know, I'm fully expecting to be able to get my sell order filled. And in fact, the stock is so strong, as I fast forward here again just a couple minutes, we came back down to 28. All right, off that high, I'm still holding the option. and just watching that dollar mark again at 28. But again, notice it can't break 28. Still defending 28, similar to the way it defended 27. And we know that when it defended 27 and made a new high above 27.70, it went up to 28.60. It went up 90 cents. So now in my head I'm thinking, all right, well, if it defends 28s and it makes a new high, I'm looking at another 70-cent rip. So I'm looking at 129.30. So I'm going to fast forward just a minute here. And I want you guys to see this new high of day action. So here we are again, making a new high. And you'll notice it does a great job staying up on this high. It doesn't keep going right away. It doesn't go 129s right away, but it just defends the hell out of 128.50 and just really fails to even come back to 128 for any type of time. And this is where I start to consider raising my sell order. It's 435 by 445. Currently I'm on ask at 465. But given the way it's defending so close up near the high, I'm saying, all right, it's taking a little pause. But if it's staying up here and it continues to make new highs, at this point I'm thinking 130 is a magnet. I'm 15 cents away from where my sell order's at. If the stock's going to move another $1.50 to the upside, I'll be able to sell this option, higher than where I'm trying to sell it right now. So right now, just watching and continuing to observe the aggressive bid activity when you try and get below 28.50 again. Just really having a hard time down ticking. Takes the asks back out above 28.50. Just going to fast forward again 1 minute. So we've held 28.50. Now we're coming right back up at the high. And look at this speed here. We've got orders going through every second. You can see now I'm raising my sell order as it's testing the high. Now I've raised my sell order to $4.80, it looks like, so trying to get an extra 25 bucks out of it. And when you make this new high, you're just going to blast off straight into the 129s. Just straight up to 129 here. Very aggressive bids. I'm on ask at $4.90 is what I ended up going with for my raise. Now you came away from 29 just for a second, but you're going to come right back up to it. So I'm still looking for that breakout to keep on going. Bid activity is still so strong. Right away, upticks above 29. So just a great reaction, great continued reaction into those new highs. We're not pulling back off of new highs. We're making new highs and we're continuing. And we saw that 2 points ago in the 127 action when it failed to come back down to 126. So the idea of how did you know the breakout was legit, the main takeaway is the inability to come back down from new highs. Here I am on ask at 490 into that new high day test as we're approaching 130. and I get filled at $4.90 from my $3.70 entry. So a nice 30% gain. And ultimately the stock keeps going here. I think it ends up crossing above 130, so could have even gotten more out of it. But as far as the question, again, how did I know the breakout was legit? The volume flow, the way it crushed through my reference point, my resistance point, which coming into this day was 126.45, which had been the all-time closing high on Netflix. And then number 3, and most importantly, is the inability to come down, the persistence of price action to the upside, where it just failed to come down even 50 cents off the high. It was just so strong. Any questions on that? Any questions on anything here? Am I looking for higher highs on the candles? Yeah, I'm looking for them, but I'm more focused on the level 2 action first, because the level 2 action is telling me the whole time that higher highs are coming. So I want to see higher highs to kind of confirm what I think I'm seeing on level 2, but I don't need level 2 to confirm the higher highs, if you know what I mean. It's like, what comes first, the chicken or the egg? For me, the level 2 action comes first, and then the higher highs confirm my interpretation. Any other questions? Alright guys, not seeing anything else. Why only the 3-minute chart? It's not only the 3-minute chart, that's just the only chart you see on this screen, but I talked about which charts I use, and I will link you to that video right now. So here you go. It's the very first answer in this webinar that I did a couple weeks ago. Make sure you check the video archive. All these webinars are posted there, and the question that I answered in the webinar I just linked you to is, why do you use a 3-minute chart as opposed to a 1-minute chart? So that will give you the exact answer you're looking for. Any others? If this were right at market open, would I interpret the action the same way, or could it be a rush of pending orders? Yeah, I would interpret the action the same way. Strong momentum is strong momentum, regardless of when it occurs. I'd maybe be a little bit more cautious, because it is so immediate. But I entered this trade around 9:42, so 12 minutes as opposed to 2 minutes into the day. But like I said, I think a good move is a good move. Doesn't matter if it happens at 9:31 or if it happens at 10:31. Once it happens, my antennas go up, or they need to go up, and I need to start paying attention. All right, guys, I got to run here. If you have any other follow-up questions, please just email them to me. I hope you got something out of this. It was recorded. It will be posted to the site within the next couple of days, and we will have another one of these probably, well, it might not be until next year, just with the holidays coming up. Hopefully we'll have another one within 2 weeks, but our next one for sure will be the first week of the new year. Remember, we only have one more full trading week left. Next week we have a full trading week. The week after that we have Christmas Eve and Christmas Day. The week after that we have New Year's Eve and New Year's Day, both on Thursday, Friday. So 2 3-day weeks, or 3.5-day weeks coming up here after next week. So just be prepared for that. All right, thanks guys. Have a good night. I'll see you tomorrow morning.